Okay, we're going to talk a little bit about decision making here, and more so too, I think that decision making is often more easily understood when you can look at some actual examples. So, for the most part, when I talk about this with respect to the PowerPoint presentation here, I'll keep it more general, but I'll try to use some verbal examples as well. Now, when we talk in terms of a decision model, it's just basically the decision maker decides, number one, what am I trying to decide? For example, if I decide I need to buy a new car, okay, that's my decision. I'm going to do that. All right, what are the criteria I'm going to use to make that decision? Well, one could be gas mileage. Okay, the overall gas mileage has to be greater than 30 miles per gallon. It has to cost less than $30,000. Again, those would be my model always has an objective to do something. It could be to purchase something, it could be to minimize cost, whatever the case may be. But a decision model also means I have to have some sort of input to make that decision. All right, I have to quiet my phone there. All right. Now, again, the role of management accounting is to provide the information to help managers in particular make these kinds of decisions. Now, I wouldn't make a huge issue of this 5-step process. But again, a decision is identify the problem. I need to buy a new machine. This one seems to be not working. Okay, there are two alternatives that I can use. Okay, I have choice 1, choice 2. Which one will minimize my cost? So my production cost. So I'm going to use that as my criteria, the one that will have the lowest operating cost, and then provide the information that will help me evaluate operating costs for that. Many times it can be sort of maximizing income, could be the objective. Sometimes the objective is to minimize cost. So again, those are the idea behind a decision model, decision-making process. Now, relevance. Relevance is an important issue. And a relevant cost or relevant revenue is always going to be something that happens, for example, now or in the future. Now being, okay, I can decide to spend money now. I can decide to buy this. I can decide that if I do this, this income is going to come in. Now, the second criteria that has to be different, we'll look at it. I think some of the problems that you'll see, we'll look at that. And if the cost is $3 under alternative 1, $3 under alternative 2, now I can include that and I'll end up with the right decision. But again, sort of mathematically, I can subtract 3 from both sides of the equation and the nature of the equation does not change. So that's kind of what they're getting at when they talk about cost or revenues that are the same and not particularly relevant. Now, one thing that's extraordinarily important is that anything that's happened in the past is always going to be considered to be irrelevant. That's a historical cost or a sunk cost. Why? Because I can't do anything about it. So, for example, if I pay $10 for a share of stock, all right, fine, I paid $10 for it. Well, let's say right now the current market is $8. The temptation is to think, oh, I've lost $2. Well, that's true in terms of your original purchase price, but the original purchase price cannot be the decision criteria. The decision criteria about do I keep the stock, do I sell it, is got to be based on what is the current market and what is the future market going to be. So if you believe the future market is going to continue to go down, well, okay, fine, maybe you made a bad decision, but you need to get out now. Better to take $8 than to take $7 or $6 or $5 for that share of stock. So now, I can always go back and look at the decision to buy the stock in the first place. Why did I do that? What mistake did I make in purchasing that? That's appropriate to do, but I can't use the $10 as a comparison against the market because again, I can't do anything about that past cost. There are quantitative measures, and we'll look at those. There are also qualitative factors that enter into this too. And we'll look at some examples of that when we look at particularly special orders and some other things as well. Again, you need to look at what would be relevant. Relevant, again, is always kind of projecting forward. these are things that are going to happen in the future that are going to be different between the alternatives that I'm looking at, okay? Again, differences in revenues, differences in cost, never looking at past cost. And for example, the cost of machine and its associated depreciation would always be irrelevant in terms of making a decision. So again, these are things that are always going to be important in terms of making a decision, but also too that you need to be careful that you don't allow a thing like sunk cost to affect the decision that you're making there. Now, here's an example of what I'm talking about, what's relevant. One, if you look at what is different between the two alternatives. Well, what they're saying is, okay, look, if you make a $90,000 investment to reorganize your company, your manufacturing process, you will need less labor. You can go from 20 workers down to 15 workers, a decrease of 5 workers, by just simply streamlining the operations. Doesn't change the output, doesn't change the quality of anything, okay? So these are what I'm looking at. Do I make the $90,000 investment with the idea that in the future I will save some cost, okay? And the cost savings is a function of the decrease in the number of workers. So I can do this. One, I can say no, that is maintain the status quo. And I can go through and look at my entire income statement and say, okay, if I maintain the status quo, that is with 20 workers, I will have operating income of the 1.61 million. All right. Alternative 2 is, yes, I will make it, but I have to recognize that there is a cost here, but I can bring those labor costs from 640 down to 480. So I can do the entire income statement and find, oh, look, okay, the net difference there is I'm $70,000 better off. And you're never wrong doing it this way, just what I call create the income statement format. The other thing is I can focus in on only those things which are different, okay? Well, the first and primary thing that's going to be different would be the manufacturing labor. If I maintain the status quo, I will continue to pay $640,000. If I make the investment, okay, then given I only have 15 workers, my labor cost will only be $480,000. However, if to do that, I also have to make this investment. Okay? So my total cost here, okay, 640, but I have 480 plus 90 or 570. And again, the difference here is 70,000. Okay. Again, the difference is always going to be the same, no matter if I include all these other things that are the same, or if I'm simply looking at the things that are different. So this is kind of looking at that issue, why when we talk about things which are only things that are different are relevant. Well, that's true. Okay, I can streamline things, but the best issue here, the best thing that I can do is to make the right decision and make it for the appropriate reason. Again, I can include all these things that are exactly the same, and I will end up with exactly the same answer. Yes, reorganize because you'll be $70,000 better. All right, again, this over and over and over again, sunk costs are irrelevant for decision making, okay? Because you can't change it. I'm only going to consider those things which I can change now and in the future. I can't change something that has happened in the past. So therefore, it's not relevant to me in terms of making a decision today. Now, I don't get too excited about the differences here, incremental versus differential cost, okay? Incremental is just seeing would be what happens with as I change activity. So incremental tends to be associated with activity, okay? So that's the emphasis here. Differential is kind of looking at the difference between alternatives, okay? Now, the reason I make this point is that most people tend to kind of slop the different, they don't really differentiate between the two. But as you're reading the textbook here, if you're looking at these, the authors are going to make they will make a big distinction between the two. And oftentimes as you're talking in terms of what's different, okay, I have to be careful that I use precise terminology, or I make sure that the people who are listening to my presentation understand what I'm saying. And we'll look at some examples here. All right, Now, special order. The idea behind a special order is, am I willing to accept a lower price for something? And um, what are the long-term implications of that? Well, the major thing is I can't focus in on the difference in the sales price. If my normal sales price is $20, somebody offers to buy something from me for 12, okay, fine. I can choose to say yes or no. That's not the issue. The issue is, will the special order at that lower sales price still generate a positive contribution margin? If it will, then all things being equal, I'm better off by accepting it. Now, you have to be kind of careful in terms of defining what precisely we mean by variable costs there. Some of the variable costs may change, particularly some marketing costs may decrease. So actually, my contribution margin may be a little bit better than I would have anticipated. Okay, so generally speaking, special orders, it comes down to a question of, will the special order, either on an individual unit basis or if I take that times the number of units I want to sell, generate a positive contribution margin? If the answer is yes, then from a financial point of view, I would say yes. Now, a qualitative consideration has come into play, and the major one would be, if I do this, will my existing customers find out about it? Will they demand the same price? So I have to be kind of careful how I apply this. But the lower sales price is not the issue here. And that in many ways is the important thing. The other qualitative factor is, if I have the excess capacity, and that's going to be one of our major assumptions, that you do have that. If I have the excess capacity, if my capacity is 20,000 units, I'm producing 15, a special order of 3,000 units is not going to cause me to throw overboard any of my existing customers. So this special order, assuming it meets the other qualitative features, would increase my overall profitability. And again, here's a simple example where they take on a special order of, they come in and offer to buy it at $11 per unit versus the existing 20. Well, most people say, well, we're losing $9 per unit. Well, the issue here is not the sales price, but what happens to these variable costs? If you maintain the same variable cost total, $12.50, then yes, I would reject the special offer because I would be losing money. If my contribution margin is negative, I waive it off. I say absolutely not. But what they tell you here is that the marketing costs can be eliminated. And so I'm only left with the $7.50 of manufacturing variable costs. So the 11 minus $7.50 should give me, if I do my mental math right, okay, $4.50. $4.50. Yeah, let me get my calculator out. No, I'm sorry, $3.50. So I would have a contribution margin of $3.50 on a unit basis. Hey, I'm good. I don't have to do anything. If it meets all the other qualitative characteristics, my other customers are not going to demand that I have to sell it to them for 11. I have the excess capacity. As long as one unit generates a positive contribution margin, then all I'm doing is multiplying that times the number of units I'm going to be selling. So in this case, yeah, I would accept it. You know, the $3.50 times 5,000 gives me an additional 37,500 contribution margin. I'm better off. Why not? Okay. My contribution margin here would be 17,500. No additional fixed costs. That's a big consideration. Now, sometimes there can be an incremental fixed cost. Okay, and that is, if I take on this, I may have to buy a one-time machine. Let's say I had a one-time machine here of 5,000. Well, even if that were the case, I would still end up with a operating income of 12,500. Throw the machine away at the end of the special order, I'm still better off. Okay, so some fixed costs can be incremental. Okay, that is, I can incur this fixed cost if I do the special order. All right, now this fixed unit issue is going to come into play when we have this issue of make or buy, in-source, outsource. Okay, and I think the best way is to look at an example here. All right, now what they tell you here, you read the fine print here, is that there are $3,000 of fixed cost, okay, for this plant. And at 250,000 units, okay, okay, that means that the fixed cost per unit is $12. Okay, now what the incentive and what they have to be careful of, the company right now thinks that if they make it, they're going to pay $72. Well, 72 is the total production cost if I assume both the variable and the fixed cost per unit. All right. The problem is the nature of fixed cost. They don't change. They're not subject to changes because my production changes. So if my production goes down to zero, I may still have to pay $3,000 of fixed cost. And that's really kind of the big question here. If I decide to go out and buy at $64, it seems attractive versus 72, okay, what happens to these fixed costs? If I'm still going to incur it, then really my total cost would be the 64 plus the 12, okay, or really my total cost here would be $76 per unit, because I have to pay the 64, and I'm going to continue paying that $3 million, okay, and given 250,000 units, it comes out to be an additional $12 per unit. So I'm really paying $76, okay? Or if you want to look at it in terms of total numbers, sometimes that's better. Okay, fine, if I make it, it's going to cost me $18 million. If I buy it, that's the out-of-pocket cost to buy the stuff, but the $3 million doesn't go away, so my total cost here would be $19 million. So insourcing, outsourcing, the big issue here, what happens to fixed cost? You know, if they're all committed, I can't do anything with it, then I'm fine, I'm stuck with it. And you need to include it, okay? In fact, I think that's the best thing to do when you're looking at this analysis. Always look at the total fixed cost under each alternative, and then make the decision, what's going to happen. Now, I may have, for example, let's say that my total fixed costs are $5, okay? Okay. Now, let's see. Should be $5. But let's say I can get rid of $2 of fixed cost. So therefore, I'm stuck with $3. So I would have 5 here, 3 here. All right, the $2 difference, okay, those would be the same under both alternatives, okay? But why not just go ahead and look at it? The $2 would be my discretionary fixed cost that I could get rid of. Now, there are times when you can factor in, for example, what happens if I decide to buy, but I can find an alternative use for this empty space, okay, for the factory. And what they're saying is that, okay, if I buy the 250,000 parts at the 64, I have 16 million of income, or excuse me, of expenses. But I can take the space here and generate additional or incremental revenues of 2.5 million. So therefore, my net cost, okay, is the 13.5 million. Well, if I can do that, and that's a big if, okay, to generate that income, fine, go ahead and buy outside. Again, you have to kind of factor in some qualitative factors, okay, about on-time delivery, the quality of the product. Those kinds of things are important. When you go to an outside supplier, you lose control over that. But many companies do it anyway, so it can be an issue, but most companies are able to deal with it. All right, opportunity cost is always a relevant issue. Most of us understand opportunity cost, we just don't use it very often in a very formal way. So, and my example would be if I were to hold out a $10 bill and a $5 bill, say you could have either one. Well, most people would look at it and say, well, duh, I'll take the $10 bill. Well, why? Because that's my payout, but what was my opportunity cost? My opportunity cost was to give up the $5 bill. So here's my benefit, 10. My cost, relevant opportunity cost is 5. Therefore, I'm $5 better off. Conversely, If I chose the $5 bill, what am I giving up? I gave up the opportunity for the $10 bill. So I have a plus 5, a minus 10. I'm $5 worse off. Most of us kind of think in that way. But identifying opportunity costs in business settings can be really difficult. So it's one of those things that's intuitively easy to understand, but operationally can be very difficult to identify, often in a business or financial setting. Again, these are the qualitative factors that can come into making a decision whether we actually make or buy, whether we insource or outsource, whether we take on a special order. Those are things that have to be considered, that are extremely important. All right, capacity constraints. The normal rule is that you always maximize contribution margin. So if I have no constraint, if product A has a contribution margin of 10, product B has a contribution margin of 5, I want to produce all of A that I possibly can and sell it. Why? Because if I sell 1 unit of B at the expense of A, okay, I'm giving up $5 of contribution margin, kind of like my $10 and $5 bill, okay? And most people would understand that. The problem comes into play when you introduce a constraint. And here you want to maximize the contribution margin on the unit of constraint. So my first analysis, okay, if I had no constraints at all, I would say, well, yeah, duh, you produce all the B that you possibly can. But that's a problem, okay? Because in the real world, I often have constraints. So the constraint is right here, the machine hours, okay? And that is, it takes, in the case of A, half an hour to make A and 3 hours to make B. So let's say I have 3 hours. You give me 3 hours. How much contribution margin can I produce in 3 hours? Well, you give me 3 hours, I can produce, what? 1 unit of A, okay? Which gives me a contribution margin of 15. Okay, with 3 hours, okay, I can produce 1 unit of A. Why? Because it takes 15. It takes me 3 hours to produce it. I'm sorry. So my contribution margin in total would be that, okay? Now, if you give me 3 hours, okay, how many units of A can I produce? Well, I can produce 6. So 6 times 4 is 24. I'm much better off, given that unit of constraint, to produce A. I'm going to maximize my contribution margin on that unit of constraint. So that's one way you can look at it. You could also say, well, in that the contribution margin per machine hour, I'd like to kind of take it to the largest amount, in this case 3, but I can only make the 1, okay? All right, so maximize the contribution margin on the unit of constraint. Sometimes called bottleneck, throughput, okay, blow up the bottleneck, get the stuff through. All right, now, the problem here, okay, and we're just going to simply look at it from the point of view of what do we do about risk? Now, first and foremost, income statements can lie, because the decision, do I keep or do I get rid of a business or segment, has got to be based on its contribution margin, not on its income statement. Why? Because many of these things are non-cash expenses, such as depreciation, and also, too, some of these are committed fixed costs, and that is, if I get rid of this operation, some of these costs go over here to these surviving. So what I want to do is kind of turn cost-benefit on its head. And I look, okay, if I get rid of risk, what's my cost? Well, my cost is I give up $400,000 in revenues. All right? When and how would I do that? I would do that if and only if I can eliminate more than $400,000 of cost right now. If I can't eliminate more than $400,000, I'll keep it, even though from an income statement point of view, it doesn't look so good. Now, again, we're not going to worry about this one here, okay? So let's look at risk. What they tell you here, okay, there's my cost. Now, I can show off my cost of goods sold right now. And likewise, too, this is a sort of variable cost. This is depreciation, rent, okay? Those I can't really do a whole lot about, again. the rent, okay, go back to the example, well, in the book, I talked a little bit about this, okay, but the marketing, the sales orders, I don't have a whole lot of costs that I can really shut off immediately. Cost of goods sold is the biggest chunk of it, but in this case, I can only turn off immediately $385,000. General administrative corporate office costs, they go over to somebody else has to pay for that. So in this case, even though the financial statements don't look so good, if I shut it off, I'm going to be $15,000 in cash. Worse, I'd rather have the cash flow, all things being equal. So in this case, keep WISC for the time being until you can identify more discretionary fixed costs to get rid of. Now, do I keep or do I replace? It depends on cash flow. It's all about cash. First of all, the old machine is a sunk cost. And it doesn't make any difference whether I bought it 10 years ago, whether I bought it yesterday. If I can save money today, then I'll do it. Okay. Now, not all of these things are relevant. And we'll scooch down here. Okay. In fact, I kind of like this analysis here. I think this is the best way to look at it. Because really it comes down to, do I keep it? Do I get rid of it? Do I buy something else? Okay. My operating costs are going to be the major factor in my decision here. Okay. So what is the difference? Okay. The differential part here. What's the difference in operating cost? Well, if I keep it, I keep up the same. But if I get a new machine, it's going to be more efficient. Now, if I get the new machine, and these again, this is going to sort of like an income here. These represent cost. Okay, so this is sort of a negative against the cost. That I have disposal value from the old machine. But in order to do that, I have to pay $600,000. But given all of that, even though I still have net cost of 1.48. So if I keep it, I pay 1.6 million operating cost. If I get it, buy a new machine, it's 1.48. I would be better off, $120,000 better off by getting the new machine. All right. So what I'll do is, again, you take a look at some of the problems. We'll talk about those. Kind of go through that on a presentation that I'll put up on Moodle as well. And I think actually looking at some examples is the best way to learn decision making.